Hey everyone, and welcome to today's Explainer. We're jumping right into a topic that is literally the bedrock of the Indian stock market, yet it's something that is so often misunderstood. Today, we're going to completely demystify the Nifty 50. Whether you're a brand new investor trying to figure out the ropes, or you've been passively putting money into index funds for a while now, this is absolutely the perfect place to start truly understanding where your capital is going. We're going to break down this powerful index so you can clearly see the gears turning right under the hood.
So let me ask you this. When you buy the Nifty 50, what are you actually buying? Most folks just assume that when they buy an index fund, they're getting this singular uniform product, right? Like a perfectly balanced basket of 50 equal companies. You put your money in, and it just gets neatly divided 50 ways. Well, not exactly. The reality of how this index is constructed is vastly different from that assumption. And understanding that difference, that's your very first step to becoming a much smarter, more focused investor.
Okay, let's dive into this. Here's the roadmap for our top-down journey today. First, we'll meet the Nifty 50. Second, we'll look at the sector breakdown and weightage. Third, we'll introduce the top 5 heavyweights. Fourth, we'll see what's actually driving index performance. And finally, we'll wrap up by understanding key fundamentals.
Section 1. Meet the Nifty 50, the macro view.
Starting at the absolute top layer, according to the National Stock Exchange, the Nifty 50 is designed to be a well-diversified 50-company index that reflects overall market conditions in India. It's been around since 1996, and over the years, it has grown into the ultimate benchmark. I mean, this is the yardstick that professional money managers use to measure success. It's the foundation for countless index funds, ETFs, and structured products. Whenever you hear a news anchor excitedly announce that the market is up today, they are almost always talking about this exact index.
But here is where we get to the absolute key to understanding the Nifty 50. It's computed using a method called free float market capitalization. So what does that actually mean for you and me? Basically, it means the index's value is based only on the shares of a company that are readily available for trading in the open market by the public. It completely excludes shares tightly held by promoters, the government, or strategic investors. Because of this specific rule, the 50 companies in the index are absolutely not treated equally. Bigger companies with more actively traded shares take up a much larger slice of the pie.
Section 2. Sector breakdown and weightage. Who dominates?
And this brilliantly illustrates what happens when those slices aren't equal. If the Nifty 50 was evenly divided across the Indian economy, you'd expect to see a lot of similarly sized categories here. But instead, financial services absolutely dominates the index. It makes up a massive 35.15% of the total weight. We're talking banks, insurance companies, housing finance, the whole shebang. The next closest sector is oil, gas, and consumable fuels at just over 10%, followed by IT at roughly 8.5%. So right out of the gate as a new investor, you've got to realize that buying the Nifty 50 is, in a very real way, placing a pretty heavy bet on the Indian financial sector.
Section 3. The top 5 heavyweights. Meet the giants.
Let's peel the onion a bit further. These are the specific megacorporations pulling the most weight. HDFC Bank is sitting comfortably at the #1 spot with 10.56%. Then it's followed closely by ICICI Bank and Reliance Industries, both commanding over 8%. Rounding out the top 5, we have Bharti Airtel and Larsen & Toubro. Now, a quick aside, market capitalizations literally change every single minute the market is open, so these specific numbers are a snapshot from late May. But the crucial takeaway isn't the exact decimal point. It's that regardless of day-to-day market fluctuations, these specific giants consistently remain the major players, dictating where the index goes.
Section 4. Driving the index performance. The fruit basket.
Okay, to really visualize how this dynamic works, let's use a fruit basket analogy. Imagine your index fund is this giant, heavy fruit basket you're carrying around. HDFC Bank, ICICI Bank, and Reliance Industries. They're the massive watermelons sitting right at the top. If just one of those watermelons shifts to the left, the entire basket yanks your arm. Now, look at the companies at the very bottom of the Nifty 50. Companies that hover around 0.5% of the index, like Dr. Reddy's or Apollo Hospitals. They are the grapes. A grape can roll around all day, it could even bounce right out of the basket entirely. And honestly, you probably wouldn't even feel a difference in the weight you're carrying. So the crucial point is this. Let's bring it back to your wallet. When you invest a single rupee into a Nifty 50 index fund, that money is not being split evenly into neat little 2 paisa chunks across 50 companies. No way. Over 36 paisa of that single rupee goes strictly to just those top 5 heavyweight companies. Let that sink in. Over a third of your entire investment relies on the performance of just 5 corporate giants.
The remaining 60-ish paisa is then thinly spread out among the other 45 companies at the bottom of the basket.
Section 5. Understanding key fundamentals. Checking the vital signs.
All right, let's move into the final layer of our top-down approach and look at the vital math underpinning this whole package. 20.27. That is the price to earnings, or PE ratio, for the index. If you're a beginner assessing value, this essentially tells you how much you're paying for 1 rupee of the combined earnings of all 50 companies. A multiple around 20 means investors are willing to pay roughly 20 rupees for every 1 rupee of actual corporate profit generated by the index. It's a fantastic baseline metric to keep your eye on over time to see if the overall market is looking a little cheap or a little expensive compared to historical averages.
Now, what's really interesting about this slide is the 1.35%. That's the dividend yield of the Nifty 50. Remember, when you own shares in companies, many of them pay out a slice of their profits as cash back to you, the shareholder. Even though most people buy the Nifty 50 for the stock prices going up, this 1.35% yield shows that the index also provides a nice, steady baseline cash return just for holding onto it. It's kind of like a little engine of passive income quietly working in the background of your portfolio.
And finally, we have 3.21. This is the price to book, or PB ratio. It compares the market value of the Nifty 50 companies to their actual book value, which, to put it simply, is whatever would be left over if you sold off all their physical assets and paid off all their debts. This ratio of 3.21 rounds out our fundamental baseline. It shows us that the market currently values these businesses at just over 3 times the raw accounting value, and that's largely driven by their massive growth potential and incredible brand power.
Well, we've covered a ton of ground today, peeling back the layers of this giant index. But I want to leave you with one final provocative thought. Knowing what you know now, with just 5 companies driving over a third of the entire Nifty 50's performance, is your investment strategy truly as diversified as you originally thought? It's a pretty fascinating question to ask yourself the next time you sit down to review your portfolio. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I'll catch you next time.